Imagine the silence in a courtroom just before a verdict. That small pause where everything can change. Refinancing your mortgage creates a similar hush on your credit profile. A few short events, a credit pull, a payoff, a new loan that move multiple levers at once. Most homeowners feel a brief wobble, underfoot, a small score dip, then a slow, steady recovery as the new loan's payment history posts. But the exact shape of that wobble depends on three mechanics you control: inquiries, account opening/closing, and reporting timing. Understand those mechanics, and you turn a scary unknown into a predictable, manageable process. Hard inquiries, the immediate nudge. When you submit a full refinance application, lenders typically run a hard credit inquiry. Each hard pull can shave a few points off your score for a short time. That's normal and usually small, but it's cumulative if the pulls are spread out. The smart borrower uses rate shopping protections. Modern FICO models usually group multiple mortgage inquiries that occur within a single shopping window, up to 45 days for many FICO versions, and treat them as a single inquiry for scoring purposes. That means you can and should compare multiple lenders, but cluster the full applications so the score only sees one inquiry effect. Different scoring systems vary. Some Vantage score models use a shorter window, often 14 days. Why this matters practically? Applying to 4 lenders across 2 months can create 4 hard pulls and 4 little dings. Do the same 4 pulls within the allowed window, and most scoring versions behave as if you only had one. So ask lenders up front whether their pre-qualification step is a soft or hard pull, and if you're likely to convert to a full application, time those full apps to fall into the shopping window. Closing one mortgage, opening another. Account mechanics. A refinance replaces one installment loan with another. The old mortgage is paid in full and closed. The new mortgage posts as a new account. This does 3 things. It can change your credit mix, the ratio of installment loans to other credit types. That factor matters a bit in scoring models, but far less than payment history and amounts owed. It can reduce your average account age slightly, especially if the mortgage was one of your oldest accounts. That affects the length of credit history metric. It clears the old account balance, and the payoff should be reported as paid/closed, which is important to avoid duplicate balances showing up. Crucially, the positive payment history on your old mortgage remains on your report. A history of on-time mortgage payments continues to help your score even after the account is closed. So if your mortgage history is clean, the refinance's long-term effect is typically neutral to positive, particularly if the new loan lowers monthly strain and reduces the risk of future missed payments. Cash-out refinances. The hidden risk. Not all refinances are identical. A rate and term refinance replaces the loan at a better rate or term. A cash-out refinance increases your mortgage balance to extract equity. The latter can increase your total debt burden and change your debt-to-income DTI ratio, the metric underwriters care about, and can also affect your credit risk if the new proceeds are used to add unsecured debt. If your goal is to lower monthly payments, the credit effect is usually clearer and cleaner. If your goal is to pull equity, model the long-term effect carefully. Increasing total debt can make your credit picture riskier if it leads to higher carrying costs or new liabilities. Scoring model differences, FICO versus Vantage score. Scoring systems don't all behave the same. FICO, the most commonly used model by mortgage lenders, and Vantage score have different rules for grouping inquiries and for weighing account age. For example, FICO's commonly used versions allow a 45-day shopping window in many cases. Vantage score and older FICO versions may use a 14-day window. Lenders sometimes use a mix of scores and versions, so you can't control exactly which model a lender will pull. Your best protection is clustering and pre-qualifying with soft pulls first. Reporting and timing quirks, overlapping balances, and brief errors. Servicers report account data on different schedules. When the new loan funds and the old servicer records the payoff, there can be reporting lags. Occasionally, you'll see both loans appear open in the same cycle, or a duplicate balance until servicers and bureaus synchronize. That's usually temporary, but if it persists, you must keep your payoff paperwork and escalate. Contact both servicers and the bureaus and supply payoff documentation to get the records corrected. Fast fixes are possible when you have proof, but ignoring the mismatch risks, delayed approvals, or confusing underwriters during the refinance. Practical score expectations, what most borrowers see. Most borrowers experience a small temporary dip, often just a handful of points, around closing. Scores generally recover within 1 to 3 billing cycles, assuming on-time payments continue and no other credit events occur. If your score was already thin or near a lender's cutoff, plan conservatively, use soft pre-qualification, and avoid extra credit moves moves during the refinance window. If you're borderline for a lower rate, small score differences can impact pricing, so smoke out the risk before you lock. Protecting your score during a refinance, a practical, lender-ready playbook. You're not helpless here. Refinancing is one of the few credit events you can plan for precisely. Follow this playbook, and you'll minimize the noise on your credit and maximize the odds of a clean outcome. Step 1. Pre-qualify everywhere with soft pulls first. Start by asking lenders for soft pull pre-qualification. Soft pulls do not impact your credit. Use them to shortlist the few lenders that actually deliver quotes you would accept. Ask each lender explicitly, is your pre-qualification a soft pull? If I convert to a full application, will the hard inquiry be clustered? Do not submit full applications until you have 2 to 4 serious prospects that look acceptably priced. Pre-qualification helps you avoid unnecessary hard inquiries and preserves your score for the actual shopping window. Step 2. Time the full applications to the shopping window. When you're ready to apply, cluster the full credit pulls so they fall within the scoring model's shopping window. Aim for within 14 to 45 days, but 45 days is the conservative safe target for FICO's most used versions. Confirm with each lender the exact timing of their credit pull and try to have the hard checks run in a tight window. This is the single biggest operational lever to limit the net impact of inquiries. Step 3. Confirm payoff and watch reporting closely. After closing, the old servicer should report the mortgage as paid in full, but reporting lags happen. Don't assume it's done correctly. Pull your credit reports 30 to 60 days after closing, and verify the old mortgage shows as paid/closed, and the new loan shows accurately with the correct balance and payment terms. If you see overlapping balances or errors, open disputes with the bureaus and send payoff documentation to both the old servicer and the bureaus. Document everything. Payoff statement, lender wire/ACH confirmation. Closing disclosures. Disputes backed by payoff proof get corrected quickly. Checklist before you commit to refinance. Pre-qualify with soft pulls at several lenders to compare without hard pull impact. Cluster full applications inside a 14 to 45-day shopping window. Confirm the lender's credit pull plan and ask when and how they will report. Avoid new credit and large purchases 60 to 90 days around closing. Prepare payoff proof and check your reports 30 to 60 days after closing to confirm accurate reporting. Plan for minor dip and maintain disciplined payments to accelerate recovery. Refinance for the long term, not a short-term score. Vanity. Refinancing is a pragmatic financial choice. Lower rate, lower monthly payment, or a term that fits your life. The tiny score wobble that sometimes follows is usually temporary and manageable. Focus on timing, documentation, and clustered applications to minimize the noise. If you want expert guidance on which lenders to pre-qualify with, the language to use when asking about hard versus soft pulls, @WiseConsultant.com can help walk you through the questions to ask lenders and the timing to use when you shop. For step-by-step coaching to time your applications and interpret post-closing reports, WiseConsultant.com is available to support borrowers who want to refinance confidently and cleanly. Wise Consulting Enterprise. We could help you in such.